Welcome back to Crypto Options Unplugged, everybody. I'm David Brickell from FR&T Financial, and my usual co-host, Imran, is not with me today. He's on a work trip in Miami, so I hope you're having fun, Imran. However, I'm delighted to be joined by Quintin Archer, a post-trade veteran who is shaping digital asset adoption in TradFi. Welcome.
Thank you, David, and thanks for having me here.
No, great to have you on, and I'm looking forward to this conversation. Slightly kind of different angle to kind of other guests we've had on. So, it's Quintin. Why don't you start by telling us a little bit about your background, what you're doing in TradFi, and what you're now doing in the digital asset space?
Yeah, sure. So, I've been working in the post-trade industry in traditional finance for about 15 years now. So, been through a few crises because it's all about crisis in that space. And I work for, first for the London Stock Exchange Group when I was, more junior in my career. And now I'm CEO of PandaLogic, a consulting boutique firm doing some strategy piece on digital assets, notably. So that's kind of my journey and background.
And when you say, for those watching that don't know, post-trade, what do we mean by that?
Sure. So post-trade is what happens after trade execution. So if you trade on a trading platform, whatever that platform is, your trade has a lifetime on its own. Yeah. And what you want to ensure is that there will be the final execution of that trade, through the end of it. So, if you take a 50-year swap, for instance, you have counterparty risk for 50 years.
Yeah. Okay, got you. All right. So career in that, and now what are you doing now?
So now I'm advising some clients in the space. So London Stock Exchange is my client, but just to be clear, I'm, views here are my own and not the views of my client. Yep. And I'm helping them shaping their digital asset strategy for notably the clearing piece. So, how do you incorporate the digital asset space into TradFi? So you can think about, stablecoin adoption. You can think about, crypto asset trading. So on that, since now 3-4 years, we have been building a platform of future and options, purely cash settled in TradFi called Digital Asset Clear, where LCH provides the risk management of it. So that's kind of one example. But then more broadly, as the digital asset space grows, everyone is thinking about, okay, how do you facilitate institutional adoption in a very safe way?
And how do we do that?
That's the $1 million question, really.
Yeah.
But I think it's fascinating to see, on the one hand, the crypto industry moving, super fast, but not having yet some of the maturity you expect from, pure TradFi players where, reputation is key. You can't go wrong. You have to take your time. You have to incorporate regulation all the way. Yeah. So you have the two worlds that don't move necessarily at the same pace and don't necessarily have the same, I wouldn't say mindset, because now I think everyone wants, global adoption, but maybe not the same primitives in how they look at things.
Yeah. So with the LCH, which is the London Clearing House, which obviously in the TradFi space, central counterparty to clear trades. You've built something very similar in the digital asset space. That's correct?
Correct. So that's one service that was launched for my client. Yeah. But it's like, you have services for repos, for swaps, for FX. So it's just kind of another area. Yeah. But looking to bridge the two worlds.
Yeah. And again, for some of the more, I guess, sort of crypto native viewers who wouldn't understand, how does a central counterparty work? What's the process flows around that? Because I think it's interesting to understand that, to then start thinking about what that means for digital assets and some of the problems it solves and maybe some of the areas of friction within a decentralized world. So tell us a little bit about what does a central counterparty do? How does that process flow work, and why that's important, certainly in the TradFi world?
Sure. So CCPs are a bit of like the plumbing of finance. That's kind of the things we mentioned about what happens after trade execution. So, and CCPs, central counterparties, do a few things, actually. They insure the risk of your positions, but for the whole ecosystem. So if you have like 10 banks on the bilateral world, every bank has like 9 possible counterparties. If you go through the central clearing model, suddenly each of the 10 banks only has one counterpart, which is the central clearing house.
Yeah.
So that creates kind of a network effect and network simplification. You have an N square, formula of relationships versus an N. So the bigger the network, the bigger the efficiency. So that's huge netting benefits.
Yeah.
I don't know if that sort of answers the...
Yeah. Okay. So I as a hedge fund, let's say, I buy some sort of derivative or whatever the product might be off of, say, a bank. Those trades get given up to the clearinghouse. So then my risk, I actually face the clearinghouse, who then faces out to the bank. So then that risk is essentially centralized and managed. It also allows you to net across all your other positions. How, in terms of the insurance around that, if there's a default within the system, how's that managed?
That's a very good question. So the way it is managed is that the CCP faces all players in the system and is the trusted party for risk management.
Yeah.
So if any bank goes bust, it is the role of the CCP to make sure that the whole system is unaffected. Mm-hmm. So to manage that, the CCP will collect provisions called margins to all of the participants on a netted basis. I mean, depends of the account segregation. There are a few subtleties, but the idea is like one bank faces the CCP and will provide margin to cover the aggregate position of its risk, and that's where the CCP then hold that money. If that bank goes bust, then it will use that money to make sure that every other party will have what it is entitled to. And then if nothing goes wrong, which is thank God nearly always the case, then that money does not belong to the CCP, so it will be given back to the bank holding your trade.
Right. Okay. Got it. So what for you have been the frictions that, like, why don't we have this yet in the digital asset space, or at least on a scale that's being commonly used? Because obviously it clearly solves quite a big problem in terms of trust and also just facilitating sort of broader leverage in the system.
So it's a tough question. So let me give you a few pointers, maybe. I'm not sure that's the definite answer, but like the way I look at that, for instance. So the first thing is like the premise that on the crypto space everything is decentralized and you want to remove the middleman. Mm-hmm. So there is that kind of idea that you don't need anyone in the middle, and the CCP being one of the middlemen in traditional finance, you don't need it.
Yeah.
The counter argument on that is you always have counterparty risk. Even in crypto, whether it's CeFi, then you have the exchange, or the custody, or if you're using a curator, or if you're using an oracle, you have so many ways where you actually have intermediaries, even though like the ledger itself can be completely decentralized. So that, I think, is the first argument. It's because people don't necessarily see yet where counterparty risk needs to be managed, meaning that expert in managing counterparty risk, like the CCP, could be useful. So I think that's probably one of the reasons. And also maybe the second reason is because CCPs are really a pure traditional finance entity, on something where TradFi was kind of pushing back a little bit, like, oh, crypto's bad, this kind of mindset.
Yeah.
So you don't necessarily see from a TradFi perspective the use case to do more crypto. Mm-hmm. And now that you have like stablecoin, that is kind of the first at scale, understood use case. But how do you make fungibility across stablecoins, for instance? How do you manage the risk of like the issuer or the minter of the stablecoin? You would see, I think, at scale the need to have some trusted party that cannot necessarily always be put on the smart contract.
Yeah. Do you think, like, given that, and obviously you're seeing probably up close the TradFi businesses and the banks, who are now clearly all starting to build in this space and move in. is this the route that they're all going to sort of need to go down in terms of to really be able to interact in this world and trade, in the ways that they were able to?
That's a very good question. I don't know is the short answer on that one. So reasons for yes is, this is the way it works right now. Mm-hmm. And again, CCPs are trusted parties. And you can see on some products already, the CCP playing a role, like a bridging role between TradFi and DeFi, for instance. So that's the reason to say yes. The reason to say no is like, maybe there will be a better model that will emerge. That's the way I look at it. It's
I guess as well, like you touched on the kind of ability to collapse all your trades and have that sort of cross margin portfolio margin benefit. I guess this is where there's friction, right, still between this on-chain decentralized world versus your TradFi off-chain world, and getting, if you want to kind of have that business alongside a digital asset business, the kind of balance sheet considerations and the efficiencies that you need to gain. So we somehow need to merge these two worlds, and I guess that's part of what you're talking about here and what we need to do.
Exactly, totally. So there is another element. Is like, how do you merge the two worlds, and knowing that the TradFi world is not going to disappear anytime soon, even if you're the most libertarian crypto maximalist. There will be TradFi for a few more years, I guess. And if you have a bigger crypto adoption and still a big TradFi, you need on the balance sheet to make that efficient. So you need the rule book, you need the capital requirements, you need all of that to be as integrated as possible. So you see that happening, namely in the US, but also, it's an ongoing question. How do you reconcile, say, MiCA with like EMIR, which is the regulation for CCPs? So how do you make sure that, you have kind of a one rule book principle where if you are facing with the same type of instrument or say same type of risk, you can actually aggregate that, make that super efficient, and really have an hybrid of the two worlds.
Yeah, no, it's definitely a challenge. What's your view on that? From obviously we're still waiting for out of the US to get some of this sort of regulatory policy in place. Meanwhile, you've got Europe sort of developing their own rules under MiCA and all this stuff. Like, what's your view on how traditional firms particularly are approaching that, and how we're kind of balancing between these very, very different, what feels like very different regulatory regimes and regulatory approach to digital assets? What's the thinking around that?
So the first thing is like, it is still emerging, to your point. And usually what you don't want in traditional finance is regulatory arbitrage. So that's why, post-Lehman, you're like the G20 mandate, to try to, harmonize some of the rules and making sure that the rule books remain consistent and coherent across the board. So on crypto right now, because it's emerging, I don't think we are quite there yet. So that's going to be a journey. Now, that being said, you hear pretty much every week now, and I can certainly hear that in my day-to-day job, like really, kind of respected institution, not that crypto are not respected, but like, the big banks or the, historical legacy players, really speaking about how do we, improve what we have? How do we change the rails? How do we make DLT part of our, market? Because they see the value, they see it's fast, it's cheap. And everyone, I think, is thinking about how do we embed that into our world? So.
Yeah. Do you think one of the ways we end up doing that is tokenizing everything in the traditional world to bring that on chain? So then all of a sudden that's an easier way of then actually kind of combining it with the digital asset world as is. What are your thoughts on I guess tokenization and what you're seeing there?
I'm quite an optimist on that. So I want to believe that it's going to happen. The question is more about the time horizon. Definitely, when you start moving value so quickly, so fast, you want to adopt that kind of technology instead of, the poster child is saying, the T+2 settlement. You want something that is, atomic settlement is the buzzword, but like you want to leverage that technology and have the fluidity and, ease of moving value around. So if that is, your premise, then what you need is to tokenize everything you can to benefit from this rails. Yeah. And the counter argument on that is, how do you deal with everything that is not tokenized? How do you deal with the custody of, I don't know, if I have a government bond, am I issuing that directly on chain, or I am just building the representation of that token? It's not the same thing. It's not exactly the same risk. It's not exactly the same legal construct. And that's where it becomes a bit, a bit difficult.
Yeah, no, it's a difficult one to, again, like I kind of, when I think of like the bifurcation between sort of TradFi and digital assets, having worked on both sides, and you kind of, and you're probably seeing this as well, you see the pace and the speed and the technological capabilities within the digital asset world to evolve and sort of develop products, whereas TradFi is slower, clunkier. I think as well, perhaps even having worked in banks, often lack investment, like technology investment. It's like you've got this two-speed world that we're trying to, if you think of it like two planes that you're trying to land side by side, and one's going a lot faster than the other. How are we going to marry that up? I mean, maybe it is that for quite some time we have to build out the digital asset world in a kind of separate, in its own kind of path, if you like, whilst TradFi kind of catches up and eventually we can merge.
Exactly. And there is also, maybe we will not fully merge. Maybe you need some pure DeFi space that is, a little bit more adventurous to push the boundaries, and that will help, elevate on kind of the area that would be the intersection of the two worlds to work,
So you almost need like this kind of interoperability between the two worlds, but to be able to still kind of operate in your TradFi world sort of separately, but find ways of that we can kind of sort of cross over that border. Which I guess like a CCP type thing will hopefully then start to facilitate. Even though I guess if that kind of goes against the ethos of decentralization and what the kind of purists will want, but maybe there's a compromise somewhere, right?
Yeah, quite possibly.
Because the question I asked you beforehand, before we came on, was in terms of what a CCP does. I think a lot of people watching think, can't we just have smart contracts perform that role? And why don't we have a smart contract performing that role? What are your views around that?
So my view is like a lot of what the CCP does can be embedded in the smart contract. But I think, as we discussed before, you can think also about, who's writing the smart contract, where is, and I asked the question, again, like, where is your counterparty risk? Who is the trusted party writing the smart contract? Yeah. How do you ensure that you have enough trust in that? Not in the DLT itself, but in the way the smart contract is written. Because, finance is always a bit of, greed on the one side and then trust on the other side. And the reason why it's so slow on TradFi is also because, like, trust is probably, reputational risk is something very important. You can't rush things. You don't really get a second chance if you destroy your reputation. Yeah. So I think if I go back to the question on the smart contracts, a lot of that can be put on the smart contract. The question is also, what's the time horizon? And do you trust something that is completely open, or do you want to have a bit more control, a bit more scrutiny, a bit of, do you want full anonymity? Do you want, to keep like a close ring of, eligible parties to your protocol? Or, there are different, I think, shades of what could happen. I think right now what is very hard to replace is the reputation that has been built over, I think, for some players, decades or century.
Yeah. No, indeed. Stepping back a little bit, as someone obviously who was very ingrained in that sort of post-trade world and TradFi world, In terms of your path into crypto and digital assets, what was and you described that your kind of eureka moment. What was that eureka moment where you went, okay, I get this? Because I understand at first you were kind of dismissive, as a lot of people are.
Yeah.
What was the moment that started to change in your mind as someone, again, who's very embedded in the traditional world and understands that plumbing very well? Yeah, what was your eureka moment?
Yeah. Okay. Thanks for asking the question, because it's where the passion comes from, really. And indeed, first time I heard about crypto was, I think, 2017. And a tech friend told me, oh, finance is dead. And you're like, okay, I've been working in that space for a while. No, it's not. And I sort of dismissed it. And then come the next bull run, 2020, 2021, I was looking for, something to learn. And that's where I first, deposited a bit of money on Binance. I think it was Binance at the time, and then created my first wallet, then started moving money, playing with a few DeFi protocol, and knowing the plumbing and the industry and how it works in the TradFi space, I was like, okay, I can move value so quickly, so easily. I'm in control, and I have a lot of agency on what I can and can't, what I choose to do.
Yeah.
And for me, that was like, wow, this is revolutionary.
Yeah.
There are so many products. And of course, it was, a lot of that was casino. It was like the NFT, the Bored Apes kind of, period. But for me, the profound impact was, forget the noise, forget the bull run and all of that. I think what this technology can do, and the ease of use, not necessarily on the UX UI, but on just moving money, the core about moving value around, compared to what I know, deep down in the TradFi space, that is going to change everything. That's really where I jumped into crypto at that point.
Yeah. And where do you, where do you see us ending up? Where do you think we are right now within that evolution, if you like? And where do you see, what does the world look like, once these two worlds collide, and that, the thing that excites you about it, what point are we moving towards?
So what is quite clear to me is, it's, stating the obvious, but I don't know, maybe not necessarily obvious for people not, being as involved as I am, is everyone right now is talking crypto in TradFi, everyone. And you see the US push. So you have regulatory clarity, you have more and more people seeing, again, stablecoin or, cash on chain being the first at scale use case, for cross-border payment, for, inflation hedge, or, whatever that is, and tokenization. And you start to see some platforms. So I have Quintin network, again, not necessarily, pure DeFi players would know about this one, but on the TradFi space, you hear these kind of names or platforms that are a bit more institutional grades in the sense of, pure big banks players. And you see those platforms, scaling some, protocols or services. And you can certainly see that there is more adoption at a scale that I think crypto has not seen. And with the US push that is very pragmatic and, trying to promote this kind of acceleration, that's what I see happening. So maybe not necessarily straight away the crypto trading, exploding, because I think it's a different layer. But the adoption of DLT technology in sort of networks that are not completely open but not completely closed either is the next evolution, I think.
Yeah, and we had an interesting conversation around, because I think the first step for particularly for banks and what have you, who at first just dismissed kind of Bitcoin, crypto, the whole thing. The next kind of stage was, okay, we understand, we now get blockchain, we see the benefits and the efficiencies that brings. And then we've kind of moved into, we'll have a private blockchain then. You had some interesting thoughts around that and that evolution. Tell us about that.
Yeah, sure. So, yeah, actually, I had to fight internally. Internally meaning when dealing with people from the TradFi space a few years ago. you had to fight with the mindset that, oh, crypto is bad. Public blockchain, oh, don't touch it.
Yeah.
It has to be, permissioned and private chains. And that is if you ever even consider blockchain as a technology. And at that time, I was like, well, the issue I have with that reasoning is, the technology itself matures as an open source ledger, to a great degree. And that is the community that is building the tech resilience and also the use cases and also the adoption. So even if you believe in the private chains, the reality is that the best technology is public technology right now.
Yeah.
And you can even, if you think about, Ethereum being, kind of the backbone of pretty much all of DeFi, everything is more or less EVM compatible, not making, enemies here, like just saying that, there are excellent chains and excellent alternatives. But what I'm getting is like, you need that kind of level of trust built over time on the technology itself for it to, host more use cases and more, protocols and more services that would be DeFi services. So where I'm getting with that, I'm getting to, you have to have public chains because it's where the best products will be developed, even though they are not necessarily safe enough yet, or they don't have the right KYC yet. But like the underlying core is the best. And that it will continue to grow for a very simple reason is that how would you even enforce closing all of that, if that makes sense? Meaning that for the public chains to disappear, you need to have pretty much every government, to forbid those things. And that is not going to happen, or very, very unlikely. So if it is not going to happen, then it's going to grow because that's where, people go, and it's ease of use and it's ease of, moving money. So more capital, more talent, more development. So that grows. And at some point, if you can't really completely erase it, which you can't, then you will, there will come a time where you have to connect to it. And I think that's, I take JP Morgan as a good example, where it was all, to begin with, like, no crypto, only private, and slowly but surely evolving and considering public chains. And I think that's where we are.
So do you think, like, because obviously you mentioned JP Morgan, Citibank comes to mind, like these banks that are building their sort of private blockchains, again, just for the efficiency of settlement and all these things, they will necessarily need to be interoperable with the public blockchains like Ethereum.
I think so.
Yeah.
I think so.
Yeah.
Why would you choose JP Morgan chain or, Citi chain? There is also that. How do you make that interoperable? How do you trust one bank to be, the de facto standard for everyone? So, I think the main, one good benefit of public chains is like they are open, they are public.
Yeah.
And that does not prevent you from having some layers of KYC, some layers of control, of anonymity. So you can do quite a lot.
And I guess it goes back to who in terms of achieving scale and the network effects, like, and particularly when you think within the banking system and a global banking system, who's going to trust one individual bank to have the network that everyone's going to build on? No one's going to trust that. So therefore, you will have to go to a more decentralized, trustless sort of blockchain.
But again, I think on that it's also it's a very personal view here, and I don't want to sound too pedantic on that, because those are still very big players, and there may be cases where they one bank or another manages to create a very big network, and that works super well. I think I want to keep a bit of humility on that. I don't know the future. It's just like I really think that irrespective of what each bank is going to build, or each traditional actor, TradFi players, legacy player, you need, at some point, you will need to connect to the public chains, and you need to integrate the public chains. That's my strong belief.
Yeah, that's one that I agree with. And again, I just think it's an evolution of people's thinking, and like you say, I think they're starting to see that. That you can't build this privately, and again, you just need this interoperability. Okay, there's certain things that you'll be able to do and sell and what have you, and execute on your own private chain, but you're going to need to be able to kind of connect into the public blockchain to have more scalability in what you're trying to achieve. Tell me about you're in stealth mode as well, a project that you're building on Deribit. What are you doing in that space?
So that's it's my baby. So still in stealth mode. We're still thinking about the right way to to build that. But yeah, I think it comes from. So what's the idea? The idea is right now on the DeFi space or in the crypto native space, you start to see emerging some lending, borrowing, and fixed term, but it's still nascent. A lot of the DeFi, if I take, I don't know, Aave or the DeFi protocols, you can put your assets and then you have like a borrow rate, but it's kind of instantaneous rate. So it's very hard to have something that you would have in TradFi, which is a fixed term exposure for your interest rates.
Yeah.
And then you can do a swap, then you can do a repo, then you can do many things. But it all starts with, in TradFi, the government bonds, which are your primitive on your yield curve.
Yeah.
So what we actually did, it's backed by research as well, is like what you have in crypto, and that's kind of fascinating, is you have a very liquid derivatives market. Mm-hmm. So you don't have a bond market, which is kind of the simplest thing you can think of in TradFi. Yeah. But you have a very liquid, creative, and lively derivatives market. Yeah. And the beauty of derivatives market, it's there are pricing formulas, and if you reverse them, you can extract some hidden parameters, namely the rate. Mm-hmm. So our product is to connect to Deribit and to extract the risk-free rate on the Deribit options ladder, and from that creating an implied yield curve that you can lock fixed rates against. That's kind of the gist of what we're building.
Yeah. So how just thinking like, so if I want to, if I want to essentially achieve like a yield, a fixed term yield, like what does that look like? How do I do that with what you're kind of proposing with the product that you're building?
Yeah. So the product design is going to shift a little bit. So the way we look at that right now, it's going to be a fund compartment. That's kind of the day zero product where you can just put your money and we invest more or less like a money market fund type of logic. Yeah. But of course, the idea is once you start to have a bit of liquidity, you can also have this kind of fixed term lending and borrowing possibilities, and you can build all sorts of crazy stuff, which we have, we have lots of ideas on that. But yeah, the idea is if, I don't know, it's more of if you're a treasury in the DeFi space, you have your assets and maybe and I think it's what's happening right now, that people are not necessarily looking for as much casino yield as before, but you still have a lot of money. You want to play it safe. You want to have like more of a moderate return over time. So, which is pure ALM in the TradFi space again. So if you're a player and you're looking for, 6 to 8% return, fixed rate for 6 months, 9 months, then our product is one way to get that.
Yeah, and so just talk me through how you're generating that yield on Deribit. So what are the kind of strategies that I guess underpin the yield that you're generating?
So what we do is what's called a box spread, and then we run an optimizer on the live order book.
Right. So for those that don't know what a box spread is.
Oh yeah, sorry. So box spread is a combination of options where you neutralize the market risk of the instrument to have a fixed guaranteed end value, if you like.
Right. Okay.
So it's kind of a zero coupon bond in finance that is implied from the option strategy.
Yeah.
Meaning that you pay something today cheaper than the terminal value. That's the principle. Yeah. I don't know. You pay 95% and you get 100%. 6 months from now.
Yeah. So you're locking in spreads on various option contracts that generates a yield that would return to.
And that is locked at trade inception. So know your final value.
Yeah. Yeah. So interesting. So yeah. So what's the roadmap looking like for that? If you're able to reveal.
So we are looking for partners right now.
Yeah.
So looking at incubators or people who are crazy enough to believe in us to start building the product.
Yeah.
As anyone in the early journey, what we have is a lot of the code, the prototype, and we also put a bit of our money to just show that we are quite confident in what we do.
It sounds interesting. I mean, I think it's particularly it's quite timely, I guess, given with all the sort of Bitcoin treasuries, crypto treasuries, and I think there was a big race to let's just accumulate assets on the balance sheet. Now it's like, right, how do we generate yield and this kind of yield generation, particularly term yield and fixed yield, is going to be become a bigger topic for everyone. So so I think what you're doing in that space is interesting. So good luck with that.
Thanks.
I think coming back to markets, so usually Imran and I will have a good sort of conversation around markets. Interesting time, I think, at the moment. There's a couple of things that I guess just to highlight that I thought were interesting from last week. Obviously, I mean, and we've been talking on here a lot about the some of the liquidity stress that we've been seeing in the US financial system. And a big part of that has been this rising TGA, the Treasury General Account, where we've had this shutdown, and the US are still receiving sort of receipts, still issuing debt, but they're not able to spend it. Obviously, we're now moving towards a resolution there and the end of the shutdown, which I believe should be tomorrow, I think, when it goes to the Senate. So I think that's quite a big sort of point, a big kind of pivot point for these markets, because then we'll be able to see this sort of drawdown on the TGA and that kind of eases liquidity stress, which has been easing in a way. The other big thing that I wrote about in my newsletter, Connecting the Dots on the weekend, was, and I don't know if you saw this, Quintin, but the New York Fed's John Williams gave a speech at the ECB on Friday, and he actually talked through a lot of these liquidity tools and mechanics and what the Fed used to kind of ensure sufficient liquidity in the market, and he talked about the standing repo facility, the reverse repo facility, all these things that we've discussed quite a bit on here, but he talked about when we go from kind of abundant to ample liquidity, that would be a time for then the Fed to start purchasing assets again and expanding the balance sheet. And he kind of used the words that we're getting close to that point. So I thought that was a really interesting development for me. And just as I update on the kind of macro thinking, I actually think he's kind of hinting that the Fed are going to start those operations ahead of the end of this year. I think they're going to try and get ahead of this year-end liquidity crunch and funding crunch that you tend to get. So I think that will be quite a big moment for crypto. I called it not QE, because we're going to have all the sell side brains trying to debate that this isn't QE, which is not in terms of by definition, and it's not in terms of its intent. But what it is, ultimately, we're still kind of monetizing the debt, and they're essentially, you're talking about the Fed really printing money, expanding the balance sheet to really fund the deficit, and it'll be done through a monetary operation, which is, it'll be put out there as being technical to essentially supply liquidity to the market, but essentially it all comes to the same thing, and we're a function of liquidity. So I think that was a really important development on top of obviously the reopening, which tentatively want to call the bottom in this market, and I think Bitcoin needs to get above 107k to really kind of stave off that sort of bearish momentum, but I think that's really important. So I think we're looking good here. Imran might be in Miami, but he still took some time out to just update you guys on the vols and what he's thinking about from a vol side of things. So take a look at this.
Hey everyone, it's Imran from Options Insight, back live from Miami. Look at that beautiful view out there. All right, so I'm going to quickly run through what is going on, because I can't be there this week. So I'm going to quickly run through what's going on in Crypto Vol and what we're seeing this week. Before that, I'm going to jump in. I'm going to have a look at the chart on Bitcoin. Okay, so here I've got the chart on Bitcoin. You can see we were obviously on our knees down there near sort of 100k. Big level for the market, that kind of 98 to 100k support zone. It held. We had some decent news. Looks like government shutdown is going to end soon. Looks like there's an agreement in place to kind of, roll the voting out a bit, and whatever it is these lot want to do, they seem to have delayed the decision a bit, and the market's taken that positively. Really, the big hurdle to get through looks around this kind of 108 to 110 area to really resume the bullish impulse. So we're not out of the woods yet, I don't think. We also got this 200-day MA coming in there about 110k as well. So really, you'd want to get back above those MAs, back above 110k, and trying to make a test again for that 117 zone again. So I don't think we're out of the woods yet, but we have got the bounce, which seemed likely from where we were. So really now the question is what happens next? Remains to be seen. But in general, if we are going to get this TGA drawdown that we've been talking about and liquidity coming back into the market, then you would think that the rally can resume. But anyway, that spot, let's jump into what I'm seeing on the vol side. So here we've got realized volatility. We were 40, spiked to about 50, have been grinding a little bit lower, but we're coming in at between 40 and 50 right now. So let's say mid to low 40s. That was on the rally. Because we had the knee-jerk higher, obviously that's kind of preserved a bit of realized vol, whereas implies have started to trend lower. And that has created this kind of negative carry, negative volatility risk premium VRP. That's what that means. That's just saying that implied vols are currently lower than realized, but that's because realized has been high and we've had a violent snapback as well. Once realized vol kind of settles into a range, you will see that orange line trade back down and carry will go a bit more neutral again. But the minute we're showing negative carry, which means implieds are trading cheap to the historic realized that we have seen. But this is typical when markets sell off on high vol and then bounce. It's very typical to see this. And so I wouldn't necessarily take it as a signal to buy vol because it's trading below realized. Generally, implied vol leads realized vol, and so that move lower in implied is signaling that the options market believes we are stabilizing and realized vol will start to come down as the days go by. All right, looking at the term structure, you can see a shift lower in Bitcoin, about a couple of vol points, as you can see in the front, and pretty flat in the real long end there. So kind of the whole curve shifting down, but really being driven by the front, where we were in an inverted term structure, marginally inverted. We are now back to kind of mostly contango. Looking at ETH front end was actually quite high up there at 75. Has come in a bit, but most of the curve from sort of 2 weeks onwards has actually shifted higher by a couple of vols. So you can see more of a parallel shift higher in ETH vol, because again, that ETH bounce was pretty aggressive, order of magnitude near 10% quickly. So the market doesn't really want to let you have that vol too cheaply when it can do those kind of wild swings. Here's the kind of time series. Obviously, the highs that we got in the short end vol and the 1 week was about 52 on Bitcoin, did get crushed back down to around 40. And right now you can see we've got the front end of 40 and the back end at around 46. Ethereum highs in vol were much higher, but around 90 in the front end. Obviously, the whole curve then collapsing back. And we're sitting at about flat around 70 vol right now in terms of across the curve. Looking at skew, obviously, markets were weak, so put skew was pretty well bid. You saw about an 8.5 vol put premium in the 1 week. And then as we have started to bounce, you've seen that erode back towards only a couple of vols. But you can see the curve's pretty flat in terms of skew. I'll show the term structure in a minute, but you can see in general that skew has compressed back, still in put premium, but much narrower than it was in that front end where we were seeing like 8 vols, things like that. Same story in Ethereum. We had very extreme put premium previous. That's coming from like 10 vols all the way back to around 3 in that 1 week. And then those calls in the long end still retain a little bit of a bid. See that here on the term structure. This steep contango in the red line shows that put premium was, quite elevated. But as we've bounced, you can see it's only about 3 vols now in the front, and that back end kind of staying where it was. Ethereum, you can see that doesn't really show quite the extremes that we were at in terms of when it was like minus 10, but again, that Ethereum put skew coming in at around 3 now. But as we go through to January, kind of flips through 0, and you can see there's a call premium in the expiries like March, June, September next year. Looking at relative value side of things, you can see here a shift higher over the course of the week from about a 25, 26 vol in the front up to around 30. So Ethereum holding more of a bid again in vol, having a 30 vol premium to Bitcoin, but that has been very consistent now in that order of magnitude. It doesn't seem to be going anywhere, and actually it's propagating across the whole curve. So you can see even sort of March next year has gone from sort of 22 to 24.5. So this is interesting to see even the back end vol spread moving higher, as this is becoming very structural, that there's just not as much supply of Ethereum vol. The realized vol is consistently higher than Bitcoin, and it just seems there's just not as much appetite to sell Ethereum as there once was. So Bitcoin very much being used as the funding leg for vol selling strategies. All right, guys, that is your quick summary of what I'm seeing in crypto vol this week. Cheers.
Well, thanks for that, Imran. Thanks for taking some time out. And Quintin, thanks very much for coming on this week. It's been really interesting to kind of get your views on the world.
Well, thanks for having me, and I hope I could convey a bit of my passion for the topics.
No, it's great, and also like it's brilliant in terms of what you're doing because as much as the crypto purists, kind of almost want to keep the TradFi world out. We all need to live together, and the stuff that you're doing to facilitate that TradFi adoption is excellent. So thank you, and good to have you on. And remember, guys, like and subscribe, and we shall see you this time next week.